Good day, class. Welcome to the third session of Demonstrate an Understanding of the Function of the Market Mechanisms in a New Venture. In this session, we will analyze the factors that influence economic activity. Economic activity can be seen as a cycle. An organization pays their employees a salary. The employee spends the money to buy products and services. The organization that the products and services are bought from use the money to pay their employees so that they can buy more product and services. Every time money changes hands, it creates economic activity. The more economic activity there is, the healthier the economy. If majority of people save their money rather than spending it or investing it, will result in an economic shutdown that reverses the cycle. People stop spending, resulting in businesses having less sales, which will cause the business to spend less and eventually lead to recession. There are different factors that can cause people to stop spending, such as employment, confidence, events, and other factors. Employment is a necessary factor for economic activity to take place. When a person becomes unemployed, they do not have an income, and in turn, they stop spending. On the other hand, if a person gets a job, a raise, or a bonus, then they will have money to spend. The confidence of employees and businesses gets reflected in economic activity. If an employee has employment but no confidence in their ability to keep their job, then they'd rather save than spend. The same applies for a business in the sense that if a business is making profits, then they are likely to spend and invest as opposed to when profits drop, which results in the company spending less. There are a number of factors that impact confidence, such as financial news on spending, employment, or other economic indicators. Major events can influence economic activity, such as Christmas or a World Cup. Events like these increase consumer spending. Negative events, such as riots and natural disasters, can result in a slowdown of economic activity. Because of the state of the nation, the consumers become more careful on how they spend their money. Recovering from a natural disaster in turn can stimulate economic activity because we need to buy resources to make repairs on the damaged infrastructure. Other factors that influence economic activity include prices, interest rates, and taxes, depending on the level of confidence. If the prices, taxes, and interest rates are low, then individuals and businesses have more money to spend and might find borrowing money to be a great solution. If the conditions are the opposite, then people spend less money and borrow less money because of the high interest rates. Inflation is an increase in the general price levels of goods and services in an economy over a certain period of time. Inflation is also described as a decline in the real value of money, which is the loss of purchasing power in the medium of exchange that is also the monetary unit of account. There are four different concepts of inflation, which are deflation, reflation, stagflation, and disinflation. Deflation is a persistent downward movement in a price level. Reflation is a moderate degree of controlled inflation. Some economists define it as inflation taken deliberately in order to relieve a depression due to the fact that when prices go down drastically, then government activity stops being profitable. Stagflation is when there is an increase in price levels and a decrease in output and employment. Stagflation is derived from the words stagnant and inflation. Stagnant inflation and the rise in prices go hand in hand. The rising costs of inputs cause the prices to increase without output growth and with a reduction in unemployment. Disinflation is when an attempt to bring down prices from high levels is made. The government makes use of certain monetary and fiscal measures in order to bring down prices without causing unemployment. There are factors that cause money to lose value. Currency depreciation results in money losing value and purchasing power. The currency fluctuates on a regular basis. The daily fluctuation is a result of investor supply and demand, and rather not entirely caused by an economic event. Let us look at three factors that result in money losing value. These factors are inflationary pressure, national trade deficit, and economic money supply. The greatest factor in currency depreciation is inflation, which occurs when the general prices of goods and services are on an upward trend. If inflation occurs rapidly, it results in the depreciation of currency. This is caused by the fact that consumers spend more money on goods and services during inflationary periods as opposed to non-inflationary periods. A steady inflation rate is a positive event because it reflects economic growth. National trade deficit is when a country's imports exceeds its exports. This results in a trade deficit. Trade deficit causes the country's currency to depreciate when compared to its trading partner countries. Economic money supply refers to when the federal governments adjust their monetary policy in attempts to find an equilibrium between the supply and demand for money. The two common ways of increasing economic money supply is through printing new money or through selling government-owned securities. If none of these actions are taken, then the currency depreciates due to the fact that money supply exceeds its demand. Let's look at the role of foreign currency and exchange rates in the general economy. Foreign exchange is important because it determines the value of foreign investment. A volatile exchange rate discourages foreign investment, so does a high stable one. A low stable exchange rate is what motivates foreign investment if it is at the price of the low valued currency's economy. We will look at three factors which might contribute to the exchange rate and how they might impact it, which are a volatile exchange rate, a stable high value, and a stable low value. A volatile exchange rate results in foreign investors not being able to accurately predict their investment returns, regardless of its stability and consistent returns in foreign currency. If foreign currency is capable of changing value dramatically, then investment is just as volatile. A stable and high value currency promotes import markets while discouraging the export markets due to the fact that foreign investors can increase their return on investment by making money in a currency that is worth more than their own, and in turn exports are harmed because they are not worth as much overseas as they are at home. A stable and low currency promotes exports while discouraging imports because goods sold overseas are sold for higher value currencies that are worth more than their face value due to the currency value. Importers have little incentive to bring goods into a country because of the need to mark up the goods in order to make up for their losses due to the low currency rate. Before we come to an end of our session, let us briefly look at the role of GDP and balance of payments. Balance of payments is a method used to monitor all international monetary transactions for a country within a certain period of time. It is normally calculated every quarter and every calendar year. The balance of payments takes into account all of the trades conducted in the private and public sector in order to determine the sum of money going in and out of a country. The money paid by the country is debit and the money received is credit. In theory, credit should be equal to debits, which will result in a balance of payments that is zero. But this is rarely the case. The BOP can let us know whether the country has a surplus or deficit and from which part of the economy it is coming from. Double entry is one of the main factors that contribute to the balance of payments not being zero. Gross domestic product is the market value of all the final goods and services produced within the borders of a country over a given period. GDP per capita is GDP divided by the country's total population, and it is used as an indicator of a country's standard of living, but it is not a measure of personal income. GDP does not include intermediate goods. This is done in order to prevent double counting. We have come to an end of our third session. I recommend that you go through your learner guide so that you can learn more in depth of how GDP is calculated and what is not included in the calculations. We have completed the session and we will complete this unit standard in the next session.